the night the paper market broke. Last night at 11:20 p.m. Eastern, while most of America was asleep, something happened in the precious metals market that I've never seen in 12 years of analyzing this sector. $3 trillion in notional value, vaporized in minutes. Gold plunged. Silver cratered 15% vertically. The kind of move that makes the March 2020 COVID crash look like a practice run. And then, in the span of 2 hours, the price clawed back almost 2/3 of that drop. I've been a private commodities analyst and physical silver stacker since 2012. I've seen flash crashes, I've seen coordinated raids, I've seen the bullion banks attempt to reset the market more times than I can count. But I have never, and I mean never, seen a liquidation event of this magnitude reverse itself this fast. The financial media is already spinning their narrative. Fat finger error. Technical glitch. Standard margin call volatility. They want you to move on. They want you to believe this was just another Tuesday in the wild world of commodities trading. But here's what they're not telling you. This wasn't a crash. This was a failed assassination attempt on physical metal. And the reason it failed is sitting 7,000 miles away in Shanghai, where a $25 per ounce price wall just shattered every assumption the Western paper market has operated on for the last 50 years. Because while the COMEX was dumping paper contracts into the void, the East was quietly building a fortress that the bullion banks cannot climb. And that fortress is about to break the Western financial system in half. Here's my primary claim, and I want you to hear this clearly. The Western paper market just attempted to liquidate silver into oblivion. They threw everything they had at the price. $3 trillion in notional value. A coordinated dump that would have obliterated the market under normal circumstances. But it didn't work, because the East, specifically Shanghai, has constructed a $25 per ounce price floor that represents something far more dangerous than a simple premium. It represents a complete loss of control. We are witnessing the biggest liquidation event in human history playing out in real time. And the stakes here aren't just about profit and loss. This is about which market gets to set the global price for monetary metals. This is about whether the paper derivative system can survive contact with physical reality. Here's what I'm going to do in this video. I'm going to explain exactly what an arbitrage fracture is and why it signals the end of the paper market's pricing authority. I'm going to run the math on why the bullion banks are now structurally underwater. I'm going to share the specific indicators I'm watching over the next 48 hours, and I'm going to tell you exactly what I'm doing with my own physical position. Because this is no longer a trade. This is a monetary regime change moving from west to east in real time. And while the paper price says silver is $110 an ounce, the physical reality is saying something far more dangerous. Let me define something for you that you need to understand at a fundamental level: arbitrage fracture. Some people call it market bifurcation. I call it the moment the music stops. An arbitrage fracture occurs when the paper price, the price set by speculators and institutions, trading contracts in New York and London, loses all authority over the physical price. The price set by real buyers, with real money purchasing real metal in Shanghai, Mumbai, and Dubai. Here's the simplest way to think about this. Imagine two gas stations across the street from each other. Station A has a sign that says $2 per gallon. Station B has a sign that says $5 per gallon. Under normal market conditions, everyone would go to Station A, right? Competition would force Station B to lower their price or go out of business. But now imagine this. Station A's pumps are locked. The attendant shrugs and says, "Sorry, we're out of physical inventory, but according to our pricing system, gas is definitely $2. Meanwhile, Station B has a line of cars around the block, and people are paying $5 without hesitation because they need actual gasoline, not a piece of paper that promises gasoline. The $2 price is a hallucination. It exists on a screen. It exists in a contract. But it has zero relationship to the reality of what you can actually buy. That's where we are right now in precious metals. When I checked the data a few hours ago, here's what I saw. Western spot silver was trading at $110.59 per ounce. Shanghai spot silver was trading at $136.04 per ounce. That's a $25.45 premium. Now, small premiums are normal, 3%, 5%, maybe 8% during periods of high demand, but $25 on a $110 base price? That's not a premium. That's a different market entirely. And here's why this creates a trap for the Western paper market. Metal flows to where the price is highest. It's the most fundamental law of commodity arbitrage. If you can buy silver in New York for $110 and immediately sell it in Shanghai for $136, you do that all day long until the prices converge. But what happens when the Western vaults don't have the physical metal to support that flow? What happens when refineries are locked up? And I'm hearing unverified but persistent rumors about exactly that. And mints are preparing to shut down because they can't source feedstock? Then the $25 premium isn't temporary. It becomes structural. It becomes a physical vacuum that drains every remaining ounce from the west to the east. Let me address the shorts directly for a moment, because I know some of you are in that position. The entire premise of a stop-loss raid is that you can dump enough paper contracts to trigger a cascade of selling, scoop up physical metal at the bottom, and cover your position at a profit. That's the playbook. That's what worked in 2011, 2013, and 2020. But that playbook requires something critical: available physical inventory. When you dump $3 trillion in paper into the market and the price snaps back in 2 hours, that tells you something definitive. It tells you there was a buyer on the other side absorbing everything you threw at them. And that buyer wasn't a speculator hoping for a bounce. That buyer was someone who wanted the physical metal and was willing to pay the Eastern premium to get it. The banks thought they could scare retail into panic selling. Instead, they just gave the East a 23% discount on the remaining Western inventory. And now the trap is closing. Let me walk you through exactly what the market looked like when I pulled the data late last night. It was 11:20 p.m. Eastern Standard Time on January 29th. Most of the United States was asleep. The futures market was in its overnight session. Low liquidity, low volume, the perfect environment for a coordinated move. Gold was trading at $5,210.31 per ounce. That's significant because it represents the first sustained breach above the $5,200 psychological level. I've been tracking gold's behavior at round number resistance levels for over a decade, and 5,200 has been a brick wall until last night. Silver was at $110.63 per ounce. Now, that might sound high to anyone who remembers silver at $15, but here's the context. Just hours earlier, during the flash crash, silver had touched $106, a 15% intraday drop. The kind of move that should have triggered a multi-day collapse. It didn't. Instead, it recovered almost immediately, which tells me there was institutional absorption happening at the 106 level. Someone, or more likely, a consortium of someones, decided that 106 was the line in the sand. Now, here's where it gets interesting. Shanghai spots silver at that same moment, $136.04 per ounce. India spots silver on the MCX, $128.56 per ounce. Do you see the pattern? The entire Eastern Hemisphere is paying a massive premium over the Western paper price. This isn't isolated to one market. This isn't capital controls in China. This is a global repricing happening in real time. And the West is the last to know. The spread between Shanghai and the West is now $25.45. I want you to sit with that number for a second. $25 on a $110 base. That's a 23% premium for physical delivery in the East. And here's the part that should terrify anyone short this market. If the rumors I'm hearing about U.S. refineries locking up are true, then the paper price of $110 is completely irrelevant, because you won't be able to buy a single ounce at that price tomorrow. The price on the screen becomes a fiction, a ghost, a number that exists in a database but has no connection to physical reality. I've seen premiums during shortages before. I remember 2020 when you couldn't find silver eagles for less than $8 over spot. But that was retail. That was mints struggling to keep up with demand. This is different. This is the wholesale market fracturing. This is refineries, the entities that are supposed to be the bridge between raw material and finished product, going silent. If these reports are confirmed, we're not in a squeeze. We're in a system failure. I know what some of you are thinking. I can already hear the pushback from the skeptics, and I want to address it head on because the counter-arguments deserve a serious response. Skeptic argument. Number one, this is just volatility. The $3 trillion liquidation worked exactly as intended. It cleared out the weak hands, shook out the over-leveraged longs, and now silver is still 9% below its all-time high of $121. The market is functioning normally. Here's my rebuttal. A standard margin call doesn't retrace 2/3 of a 15% drop in 2 hours. Let me say that again. You don't recover from a liquidation event that fast unless there's massive institutional absorption on the other side. When silver crashed from $50 to $32 in 2011, it took weeks to stabilize. When it collapsed in March 2020, it took days to find a floor. But last night, 2 hours. That's not retail buying the dip. That's not algorithmic mean reversion. That's institutional money stepping in with size and conviction. And the fact that it happened in the overnight session, when liquidity is at its lowest, makes it even more significant. Whoever was buying knew exactly what they were doing. They knew the West had just thrown everything it had at the market, and they absorbed it all. Now let's address the Shanghai premium argument, because I hear this one constantly. The Shanghai premium is just capital controls. Chinese investors can't easily get their money out of the country, so they're willing to pay a premium for hard assets. It's not a real arbitrage opportunity because Westerners can't exploit it. First of all, at $25 per ounce, we're not talking about a tax or a friction cost. We're talking about a fundamentally different market. Second, the premium isn't isolated to China. India spot is at $128. The entire Eastern Hemisphere is repricing silver independent of the COMEX. You can't explain that away with capital controls. Third, and this is critical, the existence of the premium proves that physical metal is flowing east. If Western vaults still had abundant inventory, they would be arbitraging this spread aggressively. The fact that they're not, the fact that the premium is persisting and widening, tells you everything you need to know about the state of Western physical inventory. So let me do a checkpoint recap here, because we're about 60% through the script, and I want to make sure we're all on the same page. Here's what we know. The West dumped $3 trillion in paper contracts overnight. The East bought the dip. The price floor appears to be $106. The spread between Shanghai and the West is $25. And refineries are, according to unverified but persistent reports, going silent. But the truly terrifying part isn't what happened last night. It's the math behind the bullion bank's short positions and what happens when that math breaks. The math that doesn't add up. Let's run the numbers, because this is where the situation moves from concerning to existential. Even in a conservative scenario, and I'm being generous to the paper market here, if silver stays at $110 per ounce, the gap between paper contracts and physical silver sitting in COMEX vaults is at a breaking point. Here's the structure of the problem. The COMEX operates on a fractional reserve system. For every ounce of physical silver in the registered vaults, meaning silver that's available for delivery against contracts, there are multiple paper claims on that same ounce. The exact ratio fluctuates, but let's use a conservative estimate of 50 to 1. That means for every physical ounce, there are 50 paper ounces traded. Under normal circumstances, this works fine, because most contracts are cash settled. Speculators don't want physical delivery, they want price exposure. They roll their contracts forward or close them out for cash. But what happens when a significant percentage of contract holders start demanding physical delivery? The system implodes. Now let's stress test this scenario. Let's assume the $25 Shanghai premium persists for 5 more trading days. That's a $5 per day drain on Western credibility. Every day that passes with the East paying a massive premium, more metal flows out of COMEX vaults to capture that arbitrage. I've been tracking COMEX registered inventory for years, and the trend has been unmistakably downward. We're already at multi-year lows. The vaults are not empty, let me be clear about that, but they're also not deep enough to handle a sustained delivery demand surge. And here's the kicker. The $3 trillion in liquidation last night wasn't $3 trillion in cash changing hands. It was the collapse of leverage. It was the unwinding of derivative positions that were built on the assumption that the paper-to-physical ratio could be maintained indefinitely. But when physical demand in the East decouples from paper pricing in the West, that ratio becomes meaningless, the leverage unwinds, and the notional value of the entire derivatives structure comes into question. Let me give you one more data point that I find deeply significant. The gold-to-silver ratio. A few hours ago, that ratio was sitting at 47.1. For context, the long-term historical average is somewhere between 60 and 70. During the March 2020 crash, it spiked to 125. But right now, we're at 47. What does that tell us? It tells us that silver is outperforming gold on a relative basis. And historically, when silver outperforms gold, it's because industrial and investment demand are both firing on all cylinders. It's because the market is anticipating a supply crunch. But here's the problem for the bullion banks. Many of their short positions were established when the ratio was 60, 70, or even 80. They were betting on silver underperforming gold. They were betting on the ratio expanding. Instead, it's contracting. Fast. And every point that ratio drops represents billions of dollars in losses for the short side. The numbers don't match. The math doesn't work. And when the math fails in financial markets, there are only 2 outcomes. Either the price adjusts violently to reflect reality, or the system declares force majeure and changes the rules. I've seen this movie before. I know how it ends. So what do we watch for now? What are the specific indicators that will tell us whether this situation stabilizes or spirals? Let me give you my dashboard. The exact data points I'm monitoring over the next 2 trading days. First, institutional reaction. I'm watching for margin hikes on the COMEX. When the exchange feels stress in the system, their first move is always to increase margin requirements for futures contracts. This forces over-leveraged traders to either post more collateral or liquidate their positions. If we see a margin hike announcement in the next 48 hours, that's a red flag. It means the COMEX is trying to shake out more longs and relieve pressure on the short side. It's a defensive move, and it typically precedes even more volatility. But here's what makes this situation different from previous margin hike cycles. Normally, when the COMEX raises margins, it affects both sides equally. Longs and shorts both have to post more collateral. But in a market where the short side is structurally underwater, a margin hike becomes a one-sided weapon. The longs who want physical delivery can post the additional margin. The shorts, who are caught in a squeeze, might not have that luxury. I'm also watching for changes in position limits. The CFTC, the Commodity Futures Trading Commission, has the authority to impose position limits on large traders to prevent market manipulation. If we suddenly see new position limits announced for silver futures, that's the regulatory bodies stepping in to try to contain the situation. It's essentially them admitting that the market is at risk of a corner or a squeeze. And if that happens, pay very close attention to the timeline. Are these limits being imposed on new positions only, or are they retroactive? Are large traders being forced to unwind existing positions? Because if the CFTC forces shorts to cover, even partially, that's gasoline on an already burning fire. Second, media narratives. Pay attention to how the financial press is framing last night's move. If you start seeing coordinated stories about Asian manipulation or Chinese speculators distorting the market, that's not journalism, that's narrative management. That's the Western financial establishment trying to explain away a loss of control. I've seen this playbook deployed before. In 2011, when silver ran to $50, the media blamed the Hunt brothers' ghost and irrational exuberance. In 2020, they blamed retail stimulus check speculation. The script never changes. They always need a scapegoat that isn't the paper market lost credibility. The tell is always in the language. When you hear phrases like speculation-driven rally or overheated market or bubble territory, what they're really saying is the price went higher than we wanted it to go and we can't control it anymore. Watch for opinion pieces from former Fed officials or Wall Street analysts calling for cooler heads to prevail, or suggesting that regulators should step in to protect retail investors from themselves. That's code for please intervene to save the shorts. Now, let me give you the specific technical indicators I'm tracking. Indicator 1, does the $25 Shanghai spread hold through the close of trading today, January 30th? If it does, that confirms the bifurcation is structural, not temporary. It means the East has decided they're willing to pay a sustained premium for physical metal, and they're not coming back to COMEX pricing. Indicator 2, official statements from mints regarding inventory shortages. The U.S. Mint, the Royal Canadian Mint, the Perth Mint, these are the entities that turn raw silver into bullion coins and bars. If they start issuing statements about delays, allocation programs, or temporary suspensions of product lines, that's confirmation that the physical supply chain is under severe stress. I'm not talking about rumors on Reddit or unverified Twitter threads. I'm talking about official press releases. Third, watch the price action at the $110 level. If silver holds above 110 through the morning session today, the short squeeze hasn't even begun. This was just the preamble. This was the market testing the defenses and finding out that the East is not backing down. A sustained break above 115 would signal that the paper market has completely lost control, and we're entering true price discovery mode, where physical demand sets the price regardless of what COMEX contracts say. And here's the scenario that keeps me up at night. We're moving into a weekend. If this situation continues to deteriorate, if the spread continues to widen, if the rumors about refinery lockups get confirmed, there is a non-zero chance that the physical market simply closes. Not because of a holiday, not because of scheduled maintenance, but because the participants look at the price on the screen, look at their available inventory, and realize they cannot honor both their paper obligations and their physical delivery commitments. That's when force majeure gets declared. That's when contracts get cash settled against the will of the holders. That's when the system admits it's broken. I'm not saying that will happen this weekend. I'm saying the probability is higher than it's ever been in my 12 years watching this market. Let me be very clear about something. I'm not giving you advice. I'm not telling you what to do with your money. I'm telling you what I'm doing and how I'm thinking about the situation based on 12 years of tracking this sector. Here's my analysis. I believe the overnight plunge to $106 was a desperate, coordinated attempt by bullion banks to extricate themselves from underwater short positions. They needed a violent washout to trigger stop losses, panic selling, and a collapse in physical demand that would allow them to cover at lower prices. It failed, spectacularly, because physical demand in Asia is now the global price leader. The East is no longer taking price signals from London or New York. They're setting the price based on their own supply and demand dynamics, and that price is currently $25 higher than the paper market wants to admit. I think we are witnessing a permanent bifurcation. The London fix is dying, the Shanghai price is the new reality, and the Western financial system is going to have to adjust to a world where it no longer controls the price of monetary metals. That adjustment is going to be violent. Now here's my conditional plan, and I want to emphasize these are if-then scenarios, not predictions. If silver tests the $106 floor again today and holds, I'm personally looking to add to my physical position. I don't care about the premium. I don't care if I'm paying $3 over spot or $5 over spot, because if the system is fracturing, The spot price becomes a meaningless reference point. What matters is, can I get physical metal delivered to my vault? That's the only question that matters in a bifurcated market. If the rumors about refinery lockups are confirmed, if I see official statements from major refineries saying they're suspending operations or restricting output, I will sit on my hands and wait for the spread to normalize. I'm not selling into a fractured market, but I'm also not buying if the entire supply chain is seizing up. At that point, patience becomes the play because the situation becomes too opaque to trade effectively. If the spread hits $30, if Shanghai goes to 140 while the West is still at 110, and I'm watching for a COMEX delivery default, that would be the endgame scenario. That would be the moment the paper market admits it cannot fulfill its physical obligations. And if that happens, all bets are off. We're in uncharted territory. I want to share something personal here because I think it's important for context. I've seen crashes before. I lived through 2011 when silver went from $50 to $26 in 4 days. I watched March 2020 when the entire commodity complex imploded. I've seen coordinated raids, flash crashes, and engineered liquidations. But I have never seen a recovery this aggressive after a move this violent. Usually, when you get a 15% flush in a commodity market, it takes days or weeks for buyers to regain confidence. The market needs time to digest the selling, establish a new base, and rebuild momentum. This recovered in 2 hours. That tells me something is fundamentally different this time. That tells me the buyer on the other side has conviction that goes beyond speculation. They're not trying to trade a bounce. They're trying to accumulate physical metal at any price the West is foolish enough to offer. And if that's true, if the East has decided that they're going to absorb every ounce the West wants to dump, then the price trajectory from here is only up, because the paper market can print infinite contracts, but they can't print physical silver. What this means for the system. Let me zoom out for a second and talk about the systemic implications, because this goes far beyond just the price of silver. For 50 years, the Western financial system has operated on the assumption that paper derivatives can control the price of physical commodities. It's been the foundation of commodity markets since the end of Bretton Woods. Futures contracts, options, swaps, all of it designed to provide price discovery and liquidity while minimizing the actual movement of physical goods. And for 50 years, it worked, because most participants were happy to settle in cash, because the system had enough credibility that nobody questioned whether the paper actually represented physical metal. But credibility is a fragile thing, and once it's lost, it's almost impossible to regain. What we're seeing now is the Eastern market saying, we don't care what your paper contract says. We don't care what the London fix is. We don't care what COMEX settlement price is. We want physical metal, and we're willing to pay what it actually costs to secure it in a supply-constrained environment. That's a direct challenge to the entire derivative structure. Because if physical buyers stop respecting paper prices, then the paper market loses its function. It becomes a casino where speculators trade claims on metal that doesn't exist while the real market happens somewhere else. I think we're watching the beginning of a broader trend, the re-physicalization of commodity markets. The East is forcing the West to put up or shut up. Either you have the metal to back your contracts, or you don't. And if you don't, your price is meaningless. This has implications beyond silver and gold. This is a template for how the East could challenge Western financial dominance across multiple commodity markets: oil, copper, rare earths, agricultural goods. The mechanism is the same: build domestic physical markets with deep liquidity, establish price floors through coordinated buying, force arbitrage opportunities that drain Western stockpiles, and wait for the paper market to break. I'm not saying this is a coordinated conspiracy. I'm saying it's a rational response to a system that has been exporting inflation to the developing world for decades through dollar hegemony and paper market manipulation. The East got tired of playing a game where the rules were written in New York and London. So they're building their own game with their own rules. And if the West wants to compete, they're going to have to bring physical metal to the table. Not promises, not contracts, not digital ledger entries, actual metal. As we head into the weekend and next week, I'm going to be laser focused on a handful of data points that will tell me whether this situation is stabilizing or accelerating. First, COMEX registered inventory levels. This data gets updated regularly, and I'll be watching for any significant drawdowns. If we see a multi-million ounce withdrawal from registered vaults, that's confirmation that physical demand is pulling metal out of the system. The key number to watch is the ratio between registered and eligible silver. Registered means it's available for delivery. Eligible means it's sitting in COMEX vaults, but not pledged for delivery. When we see transfers from eligible to registered, that's usually bullish. It means people are preparing to take delivery. When we see transfers from registered to eligible, that's the system trying to conserve deliverable inventory. Right now, based on the latest data I have, registered silver sits at historically low levels. We're talking about enough silver to cover maybe a few weeks of sustained delivery demand. Not months, not years, weeks. Second, Shanghai gold exchange premiums. If the spread stays wide or widens further, that tells me the bifurcation is entrenching. If it narrows back to historical norms, that suggests some kind of intervention or normalization is occurring. But pay attention to how it narrows if it does. Does the Shanghai price come down, or does the Western price go up? Because if the spread compresses through Western prices rising, that's the paper market capitulating. That's them admitting they have to match Eastern pricing to retain any credibility. Third, coin dealer premiums in the retail market. I have relationships with several large bullion dealers, and I'll be checking their premiums over spot for silver eagles, maples, and generic rounds. If retail premiums start spiking, that's a signal that the wholesale shortage is bleeding into the retail market. In a normal market, retail premiums are $2 to $4 over spot. During high demand periods, they might hit $6 to $8. If we start seeing double-digit premiums at the retail level, that's confirmation that the entire supply chain is under stress, not just the institutional market. Fourth, official statements from central banks and government mints. Any indication that they're restricting sales, implementing allocation programs, or suspending certain product lines would be a major red flag. The U.S. Mint, in particular, has a history of being the canary in the coal mine. When they start rationing silver eagles or announcing production delays, that's usually a sign that they can't source enough silver blanks from refineries to meet demand. And fifth, the behavior of the gold to silver ratio. If it continues to compress toward 45 or lower, that's telling me silver is becoming the dominant trade and the supply situation is tighter than gold. Historically, ratios below 50 are rare and indicate extreme silver strength. We're at 47 right now. If we break 45, we're in territory that hasn't been seen since the early 2000s, and possibly earlier, depending on how you measure it. I'm also watching the options market. Specifically, I'm looking at the open interest in out-of-the-money silver calls. If institutional players are positioning for a major move higher by buying calls at 130, 140, or 150 strikes, that's a signal they think this situation is far from resolved. Large options positions don't lie. When you see heavy call buying at strikes well above current price, that's smart money positioning for a tail event. And given what happened last night, I'd say we're already in tail event territory. The next 48 to 72 hours are critical. We're either going to see a normalization where the spread compresses, the paper market regains control, and this gets written off as an anomaly, or we're going to see an acceleration where the spread widens, physical shortages get confirmed, and the system starts to crack in real time. Based on what I saw last night, I'm leaning toward the latter. I want to pull back one more time and talk about what this means in the context of the global monetary system. We are living through a transition period. The post-Bretton Woods era of pure fiat currency and financialized commodity markets is ending. It's not ending because of a single event or a single decision. It's ending because the rest of the world is opting out. China has been accumulating gold for over a decade. Russia has been buying gold and selling dollars. India's demand for physical silver and gold has been relentless. The central banks of emerging markets are diversifying away from dollar reserves. This isn't new information. But what is new is the willingness to let that accumulation drive price discovery independent of Western paper markets. For years, the strategy was quiet accumulation. Buy when the West dumps. Accumulate physical while keeping the price suppressed through paper market manipulation. Build strategic reserves without triggering a price spike that would make further accumulation expensive. But at some point, the accumulation phase ends, and the next phase begins, enforcing a fair price based on physical scarcity. I think that's where we are now. I think the East has decided they have enough, and now they're willing to pay up to ensure that Western vaults don't get refilled. Because every ounce that stays in the West is an ounce that could theoretically be mobilized in a future crisis. Every ounce that flows east is an ounce that's permanently removed from the Western monetary system. This is economic warfare fought through commodity markets. It's subtle, it's deniable, but it's devastating if you're on the losing side. And right now, the West is losing. Think about the strategic implications for a moment. If you're China or Russia or India, and you believe the Western financial system is unstable, that the dollar's reserve status is eroding, that debt levels are unsustainable, that the paper markets are built on leverage that can't be unwound, what do? You accumulate hard assets, you build your own pricing mechanisms, you establish your own delivery infrastructure. And when the time is right, you stop accepting Western prices and start enforcing your own. That's not speculation. That's exactly what we're watching happen in real time. The Shanghai Gold Exchange isn't just a market, it's infrastructure. It's a parallel system that can function independently of London and New York. And the more volume it captures, the more irrelevant the Western paper markets become. I keep coming back to one detail that I think a lot of people are missing. The crash to $106, as violent and dramatic as it was, is not the story. The recovery is the story. When you dump $3 trillion in notional value into a market and the price rebounds in 2 hours, that's not a technical bounce. That's not algorithms finding support. That's real capital stepping in with conviction. And the implications of that are staggering. It means there is a buyer with enough resources to absorb anything the Western paper market can throw at them. It means the short side no longer has the ability to dictate price through coordinated liquidations. It means the game has changed. I've been in this market long enough to remember when the bullion banks could crush rallies at will. They'd wait for silver to hit a key resistance level, dump a few $100 million in paper contracts in a matter of minutes, and watch the price collapse as stop losses triggered and momentum traders bailed. It worked every time, until now. The fact that it didn't work last night, the fact that the price bounced almost immediately, is the single most important development in precious metals markets in years, because it means the East has the firepower, the coordination, and the conviction to defend their price floor. And once a floor is established and defended successfully, it becomes the new baseline for all future price action. 106 is now the floor. Not because a chart says so, not because of technical analysis, but because institutional buyers in the East have declared it so with their capital. And if they're willing to defend 106, what happens when the next liquidation attempt comes? Do they defend 110, 115, 120? At what point does the paper market realize that they're not fighting retail speculators or momentum traders anymore? They're fighting sovereign wealth. They're fighting central banks. They're fighting nation states that have decided physical metal is a strategic asset. You can't beat that with paper. The psychology of this market has shifted. For years, traders operated under the assumption that any rally could be crushed by the bullion banks. That assumption is now being tested in real time. And if it breaks, if traders start believing that the floor is defended and the upside is unlimited, the short squeeze that follows will be biblical. I'm not exaggerating when I say this could be the event that redefines precious metals markets for the next decade. We're watching the power structure change hands in real time. Final thoughts and what I'm watching. We are in uncharted territory. The data from last night confirms what many of us have suspected for years. The paper market's control over precious metals pricing is ending. The $3 trillion liquidation event was the Western financial system's best shot at resetting the market and forcing a collapse that would allow underwater shorts to cover. It failed, and in failing, it revealed the structural weakness of the entire derivative system. The East is now the price setter. Shanghai is the new benchmark, and the $25 spread is not an anomaly. It's the new reality of a bifurcated market where physical and paper have decoupled entirely. Here's my rallying cry, and I want to be very clear about this. The paper game is ending. Physical is the only truth left. Everything else is a claim on something that may or may not exist when you need it. As we head into February, I expect extreme volatility. I expect more liquidation attempts. I expect media narratives trying to explain away the spread or blame Eastern manipulation. I expect margin hikes, delivery delays, and possibly outright shortages in the retail market. But most of all, I expect the system to recalibrate in real time. Because when reality and paper pricing diverge this dramatically, one of them has to give. And reality always wins. The situation is evolving by the hour. The data I've shared in this video was current as of late last night, but by the time you're watching this, conditions may have already shifted. If you want to understand how we got to this $25 premium, if you want to see the context of the previous silver raids this week, if you want to dive deeper into the COMEX inventory collapse that set the stage for this moment, go watch the deep dive on that next. Because this isn't over. This is just the beginning of the endgame. And I'll be here, tracking every move, analyzing every data point, and sharing what I see in real time. Because while the rest of the world sleeps, the monetary system is being rewritten. And the only question left is, will you be holding paper or physical when the music finally stops?